Hey everyone, it's me, Brandon, with Allegro Business Solutions, and you're live with us for Allegro Live Wednesdays. This week I wanted to focus on some credits and deductions that could possibly save you a lot of money. Of course, we'll be taking questions. They don't have to be about the topic. You can ask whatever you like. You can ask through Messenger, or you can leave comments, and I will likely see those. And you can ask questions at any time. So the biggest, I guess, big daddy of all the deductions that apply to regular taxpayers is the standard deduction. So you have a choice when you're filing your taxes. Are you going to take the standard deduction, or are you going to itemize your deductions? Let's take a step back. Why is there a standard deduction? This was put in place to simplify the tax process for the average taxpayer. The average taxpayer was experiencing considerable difficulty. I mean, everybody was having to keep receipts in order to claim basic deductions. And so Congress and the IRS came up with the concept of the standard deduction as a way to provide kind of an averaged amount of money that would save the taxpayers money without having to bother with the rather tedious process of itemizing everything. And this is really important because the standard deduction is worth a lot of money. In the current tax year, if you're married filing jointly, it's worth almost $30,000. We're up to $29,200. And also, if you're a qualifying surviving spouse, you can claim that. Single filers, or if you're married filing singly, it's worth $14,600, and if you're head of household, $21,900. So we're talking about a lot of money here and a lot of potential savings. So then you get to ask, well, why would somebody itemize? Hi Christy, there are a number of things that can only be deducted if you're itemizing. Things like medical expenses, certain state and local taxes, mortgage interest, charitable contributions, job-related expenses, investment-related expenses. Those can only be deducted if you elect to itemize. So, generally speaking, then we'll as tax professionals, we're going to say to folks, well, if all of those things add up to more than the value of the standard deduction, then we will go ahead and get Schedule A out, and we'll start with the receipts. We need to see receipts for everything. Not just me as an accountant, but the IRS is going to start asking, well, you're claiming all these deductions, can you prove them? So if you have a lot of expenses, then yes, the itemized deduction will probably be worth more than the standard deduction. But for most taxpayers, the standard deduction will probably be the best bet, and it's quite simple. Another one that's also worth a lot of money potentially is the earned income tax credit. And I urge folks to make sure, check the eligibility standards on this, because a lot of people do miss it because they're just not aware of what the standard is that you have to meet in order to take it. This is a refundable credit, which means it not only reduces the amount of tax liability you have, but it also, if it exceeds the amount of credit exceeds the amount of your tax liability, you get the difference back in your refund, which is a nice bonus. So it's designed to help out low and moderate income working people. The idea being that we want to incentivize work rather than reliance on other government benefits not working. The concept of credits and deductions in general is kind of the government's way to do a bit of social engineering. So instead of making a law that says, we want you to get married, we want you to have children, we want you to go to college, we want you to invest in businesses, etc., they're going to financially incentivize that by giving you a tax deduction or a credit or favorable tax rates for doing these things. So with the earned income tax credit, you have to come within a certain income limit based on your household size. The bigger your household, the more income you can bring in to still qualify for that credit. The income limits do vary based on, again, your marital status and how many dependents you've got. For 2024, the current tax year we're working on, the max credit for a family with 3 or more children is over $7,000. So, and I want to point out this too, that even childless workers could qualify. It's not just for people who have children. So, once again, make sure that you're checking on your eligibility, and if you're working with a professional like me or anybody else that you happen to be working with, make sure you're asking them if you might qualify for the earned income tax credit, because it could be costing you a lot of money to not look into that. Because it's worth so much, as a tax professional, we have to do what's called due diligence on this credit. We have to fill out a special form that says that we've asked our client all these questions to make sure, double sure, that they actually qualify for that money, because it is worth quite a bit and it is refundable. So they want to make sure that the right people are getting that money, and that we as tax professionals are giving the proper advice on who can actually take that credit. So if you're just joining us, we're talking about credits and deductions tonight. And if you have a question, go ahead and ask it, either in Messenger or comments or however else you want to do it. It's fine by me. Another credit that might be overlooked is called the Child and Dependent Care Credit. So if you've got young ones that go to daycare, for instance, so that you can go to work or go to school, then you can qualify to get a percentage of that back. And also, though, if you're taking care of a dependent parent, if you're their primary caretaker, they're in some way unable to take care of themselves medically, physically, then you could also qualify for that credit. You can claim up to $3,000 for one dependent or $6,000 for 2 or more. So again, we're talking a pretty fair amount of money that could lower your tax liability, potentially increasing your refund. The credit is available if your children are under 13 or any dependent who can't take care of themselves. There's no age limit on that. The percentage of expenses that you can claim depends on your adjusted gross income, like a lot of other dependents and credits. So we would need to calculate that first. And but some taxpayers can be eligible for upwards of 35% of their child care expenses as a deduction, or in this case, credit. So it's definitely something you want to take advantage of if you're a working parent or you're taking care of parents or family that are unable to take care of themselves. You can get some of that money back for doing that. Now, again, if you're just joining us, you can send questions in through iFaith. You can bring them in through Messenger. You can leave comments if you like. We're talking about credits and deductions tonight, but your questions don't have to be about that. You can ask whatever you like. So another one I wanted to bring to light here is the retirement saving credit. There's actually a variety of things here that can reward you for contributing to a qualifying retirement account, like an IRA or a 401k. So in addition to the deduction for your contribution, you could qualify for credit of up to $1,000 or $2,000 if you're married filing jointly. A credit, again, is based on your filing status and adjusted gross income. So we need to do some calculations to see exactly how much it would be worth. The credit is especially valuable for lower income taxpayers because it does reduce taxes dollar for dollar. So we could be talking a big difference in terms of how much of a potential refund you're getting. It is a good incentive to build long-term savings and at the same time lowering your tax bill. Typically, your retirement account will qualify for this if it's a traditional, as opposed to, say, a Roth. In terms of 401ks or IRAs, with a Roth, you're paying taxes on it up front, so that you don't have to pay taxes on it when you retire, and you're taking the money for your income. That's the advantage of the Roth. But the traditional IRAs and 401ks, you're not paying tax up front, but you will when you withdraw them. So it's kind of like a deferred salary, really. And what the advantage of that is that with the traditional retirement plans, you can take a tax deduction for those. So it might be worthwhile to look into mixing your retirement portfolio between traditional and Roth so that you can enjoy advantages both up front and when you retire. But every situation is different, so you should take into consideration what your own goals are and what your own financial situation is in terms of what you want to do with your retirement funds and your tax bill. So if you're just joining us, we're talking about taxes and credits and deductions. It is tax season. We've got taxes on the mind. That's what we'll be talking about. And we've gone over the standard deduction, the earned income tax credit, the child independent care credit, and we talked about some retirement-based contribution credits. If you have any questions, they don't necessarily have to be about tax credits or deductions. You can ask whatever you like. And you can do that through Messenger, or you can do that by leaving a comment. So let's talk about now the American Opportunity Tax Credit. This is a credit that's directed towards folks who are going to college for the first time. So if you're on your first four-year degree and you're going to an eligible institution, you can qualify potentially for this credit. So the American Opportunity Tax Credit could be worth up to $2,500 per student for tuition, fees, and course materials. 40% of the credit, up to $1,000, is refundable, so you can't get the whole $2,500 back if it should be the case. But you can refund up to $1,000 of that if it exceeds the amount of your taxable income. To claim the full credit, you'll need a modified adjusted gross income below $80,000 if you're single, or $160,000 for joint filers. And you'll need to have that Form 1098-T from your institution in order to claim that credit. And most universities and colleges are pretty good at getting those out to people. And it's kind of an informational form. It just tells how much was spent by the student or on behalf of the student. And it verifies that. And of course, that form also goes to the IRS too. So you'll definitely need to watch out for that if you want to claim the American Opportunity Tax Credit, which again could be worth a fair amount of money. Some help if you're going to college. You can get some of that money back. And again, it's one of the ways that the government incentivizes higher education by offering a tax credit for it. So if you're just joining us, we're talking about taxes and credits tonight. If you have your own questions, whether they're about deduction and credits or not, you could go ahead and ask those in the comments or in the messenger, which I'll check shortly here. Or if you just want to listen, that's great. We're going to move on now to the home office deduction if you happen to be self-employed. What this does is it deducts a portion of your home expenses if you use part of your home exclusively for business purposes. And this is only available if you are self-employed, you run a business, or you work as an independent contractor. In other words, if you work at home but you get a W-2 from your employer, you're a regular employee working from home, then you can't claim the home office deduction. It has to be legitimately something that you're independently doing. There are two different methods that you can use to claim the home office deduction. There's the simplified method and the actual expense method. With the simplified method, you simply calculate $5 per square foot that is devoted in your home to your home office. up to 300 square feet. And so long as you meet the requirements that you run your business primarily from your home, and this square footage that you're claiming is used only for business purposes, then you can claim upwards of 300 square feet at $5 per square foot. That's the simple method. The actual expense method involves taking a percentage of your mortgage, utilities, and insurance, all the essential home expenses, and figuring out what percent of the home you're using for business purposes and applying that percentage against those expenses. You can do that, absolutely. If you think that you're going to save more money doing that over the simplified method, then you should definitely look into doing it. Most people will use the simplified method because it's faster, it's easier, and they don't believe that it will save them any significant money to go through all of the household bills and do all the additional math required for that. So, this is a great deduction if you're self-employed, run your own business, but you have to make sure you're maintaining very clear, accurate records in case of an audit. And again, this is worth potentially a lot of money, particularly for those small business owners. So be careful with that. And if you run a home daycare, there are actually special rules about how this is handled, because generally speaking, just about all of your home will be used for watching the children, and you're going to use areas of the home that typically a business owner wouldn't use for in the normal course of their business. So if you're one of those people who do run an in-home daycare, make sure that you're asking your tax advisor exactly how to work that out so that you're getting the full credit or deduction for that space that you're using. Let's see, looks like we've got a question here in the messages. Okay, they're asking about using a vehicle in they run a small business from home. So like with the home office deduction, the vehicle deduction can work in one of two different ways. There's a simplified method and an actual expense method. The simplified method works on the basis of mileage. So what you do is you keep a log, you take down odometer readings, and you put the date and what you're traveling for. At the end of the year, you add up all of those miles, you multiply it by the IRS rate per mileage, and that's what you're allowed to deduct in terms of a business-used vehicle. And that's pretty simple to do because it keeps separate automatically your business use versus personal use. So the actual use method, the actual expense method for vehicles is a lot like for the home office. Again, you're going to calculate the actual expenses of maintaining your car, the car payment, gas, oil changes, whatever else you're doing. Typically, this is done if you're exclusively using that vehicle for business. Otherwise, it gets even more complicated, involving, again, a percentage of use calculation. Let's see, what else do we have here in terms of questions? Nobody wants to try to stump me tonight. I feel like I got away with something. Let's see. Okay. All right. A question from a small business owner here. Okay. The question is basically, when you're working with an accountant or tax professional, what needs to be documented exactly in terms of like QuickBooks or whatever software you're using. And generally my rule of thumb is to say, if there's any money coming into or flowing out of your business account, I need to have some kind of piece of paper or document that says why. It's not just me wanting to know, although I do. It's the IRS who will ultimately want to know why money is flowing into and out of your account. So be careful with all of your transactions. Make sure that your professionals kept up to date, and everything will be smooth sailing. Your bookkeeping and tax professional, such as myself, should be able to tell you which of your business transactions do have tax implications, and what you could be doing differently to adjust your tax liability or to improve your position in terms of your tax liability. That's why I like to think that it makes sense to have the same person who does your bookkeeping do your taxes, because I feel like one flows right into the other. And if you want to develop a long-term strategy in terms of tax savings and developing a real strategy for that, then it would be good to have somebody on board who has a long-term and detailed knowledge of your day-to-day transactions and ways in which they could be made to conform to your tax strategy. Okay, so it looks like that's all the questions I had from the audience. If there's nothing else, I'll see you guys next week, next Wednesday, 7 p.m. Thanks a lot.